Here, let's look at the requirement first. First, here is a question which saying comment on the matters to be considered and explain the audit evidence you would expect to find during your review of the audit working papers in respect of the issues described above. Okay, so what we have to do, we have to comment on the matters to consider and explain the audit evidence which you will expect to find during the review in your audit file. And so that means you are the audit manager, right? Uh, and you have to play the role of the audit manager in this question. Now, um, yeah, so it's saying it is 1st July uh, 2005. You are manager in the audit department of Pert and Co firm of chartered certified accountants responsible for the audit of Lifeson Company for the year ended 31st March 2005. Lifeson Company is an unlisted retail company which is new audit client of your firm this year. The company draft financial statements recognized profit before tax 2.15 million and total assets of 13.8 million 2004 12.7 million. Okay, is your total assets. The audit is nearly complete and you are reviewing the audit working papers. The audit supervisor has brought the following matters to your attention. And firstly, we will look at the sale and leaseback transaction. On 31st March 2005, Lifeson Company sold a property to a leasing company, Cliveco, for its fair value at this date. The property is situated in a sought after area with a high demand for retail properties for retail purposes. Clive assessed the remaining life of the property to be in excess of 50 years, and under the terms of the sales agreement, Lifeson Company will lease the property back from the Cliveco for a period of 10 years. Lifeson Co. has treated the transaction as a sale and leaseback transaction in accordance with IFRS 16 leases and de-recognize the property in its financial statements and record it as sale in accordance with IFRS 15 revenue from contracts with customers. And this requirement will help us score 8 marks. So, um, simply what I will do first, I will what I will do, I will um, discuss the first A part of the question uh, regarding the sale and leaseback issue, right? We just look at the question. Now, question name is number two, Lifeson Company. That's the A part. And number one, firstly, we have to discuss the matters. Okay. And my first heading in this part of the question is transfer of control. So now let's start discussing it. So what I will say, the auditor needs to consider the correct treatment of the sale and leaseback transaction as required by IFRS 16. which requires that an assessment should be performed based on the criteria specified in IFRS 15. uh, as to whether control of the asset, whether the control of the asset has been retained by the seller or it has been passed to the buyer. Right? So far, so good. Further, I will say control of the asset is defined by the IFRS 15 as the ability to direct the use of and obtain substantially all of the remaining benefits from the asset. This includes the ability to prevent others from directing the use of and obtaining the benefits from the asset. The benefits uh, related to the asset are the potential cash flows which may be obtained directly or indirectly. Right of use asset. In this case, the lease term of 10 years appears short compared to the assets remaining life, which is expected to exceed 50 years, and given the demand for rental properties for rent in the area, it seems likely that Clive Co. will direct the use of property and will obtain all of the remaining benefits from the asset, including the potential cash flows in the future. On the basis of information available, therefore, the proposed derecognition uh, the purpose derecognition of the property in Lives and Company financial statement and the recording of the transaction as a sale is in accordance to IFRS 15 appears to be correct. Okay. Lives and Company should therefore derecognize the property and recognize a right of use asset based on the proportion of the based on the proportion of the previous carrying amount of the asset effectively retained under the terms of the lease. In addition, it should recognize financial liability based on the present value of the lease payments and any gain or loss arising on the transaction should be recognized in profit or loss for the year. In this case, therefore, the asset has been correctly derecognized, but the auditor the auditor should investigate whether the company has whether the company has recognized the right of use asset at the correct amount, at the correct amount. So far, so good. Now, next heading relating to this part is evidence expected to be in file, right? For matters, how much marks I have scored, transfer of control so far, 1 mark, sorry, 1.5 actually, 1.5 marks for this paragraph, 1.5 for this para, total 3 marks so far till here. Then 3, 4.5 4.5, and 6, and 7. We need one more mark to get 8 marks. That means for evidences, we will get 1 mark per evidence. But obviously, for practice, I'll be writing more uh, evidences for you than required. Otherwise, so one first is a copy of the sale and lease back agreement to confirm the details related to the rights of lessee and lessor. 8 marks so far, so good. A paper detailing, a working paper detailing all key aspects of the agreement required to identify the detailed accounting treatment, including the sale proceeds, rental amounts and timings, the lease term and the lease term and the interest rate implicit in the lease. Number three, agreement of the sale proceeds of the sale proceeds as per the sale agreement to the cash book and bank statement to confirm the correct calculation correct calculation of gain or loss on disposal. Right. Number four, notes to the notes of discussion with management. In relation to the transfer of control, in relation to the transfer of control to confirm whether the correct treatment, whether the correct treatment of sale and leaseback arrangement has been determined. Okay. Copy of the client working papers, working papers to confirm, sorry, in relation to the right of use asset to confirm whether client has recognized right of use asset at correct amount. So, five evidences for learning. I hope you got it till here. All right, now we will look at the second part, which saying, let's see what it's saying. Lives and Go owns a building which it has used as warehouse to store inventory on 1st April 2004. The building, which had not suffered any historic impairments, had a carrying amount based on depreciated historic cost $323,000 and a fair value of $348,000 on this date. Lifesign Company vacated the building and moved the inventory to new, larger premises. Management decided to keep the building in order to rent it out as a storage facility to local businesses and to benefit from any increases in property valuations. On 31st March 2005, the building had not let and it had a fair value according to an external valuer of 353,000. A draft financial statement for the current year recognized the building as an investment property at a carrying amount of 353,000 and include a fair value gain of 30,000 in profit before tax for the year. Since reclassification as an investment property, depreciation has not been charged in relation to building. 6 marks available for this requirement. Now let us draft the answer. My heading investment property, and firstly we will look at the matters. So materiality. First we will compute the materiality. 1.5 marks for the materiality. So what I'll say that the carrying amount of the investment property of the investment property represent 353,000 divided by 13.8 million, that is total assets, is 2.6% of Lifeson company total assets at reporting date, and is material to financial statements. My next heading is classification as investment property. What I'll say that so classification as investment property is my next point. Till now we have scored 1.5 marks, and what we'll say in it, the auditor should consider the requirements of IAS 40 have been certified and confirm if the warehouse held by Lifeson company is actually an investment property. Lifeson company warehouse held to earn rentals or for capital appreciation, or both, right? So, Lifeson company warehouse house Lifeson company held has held has been held sorry Lifeson company's warehouse has been held to earn rentals and for capital appreciation from 1st April 2004, and therefore qualifies as investment property from this date. The fact that The property has not yet been let by the reporting date does not impact on this calculation, sorry, on this classification. The end of the owner occupation, the end of the owner occupation of the warehouse is evidence of the change in use to an investment property. Fair value. The warehouse is recognized. Now, let us discuss about the fair value. The warehouse is recognized at the fair value of dollar 353,000, and according to IS 40, the fair value model, the fair value model is acceptable provided the treatment of any other, the treatment of any other investment property is consistent. So far, so good. Um, on transfer of an owner occupied property, transfer of an owner occupied property as recognized at depreciated historical cost, which has not yet been previously not yet been previously impaired to investment property carried at fair value. IS 40 requires that any resulting increase in the carrying amount should be recognized in other comprehensive income as as a revaluation surplus within equity. Thereafter, any further increase in fair value is recognized in profit or loss for the year. In this case, lifestyle company should recognize the initial increase in fair value is recognized in profit or loss for the year. In this case, the license company should recognize the initial increase of 348,000 minus 323,000, that is $25,000 in other comprehensive income, right? Rather than in profit or profit for the year, rather than in profit for the year. Okay, now an additional increase of 353,000 minus 348,000, that is $5,000 increase, should be recognized in profit or loss. Okay, license company recognition. Recognition of full $30,000 gain in profit before tax for the current year is incorrect, and therefore result in an overstatement of profit by dollar 25,000. So far, so good. Next heading, evidence expected to be in to be on file. Now, what I'll say first, what I will expect as a manager to get notes of discussion with management, notes of discussion with management, and now why I needed to confirm its intention to hold property, earn rentals, and for capital appreciation. Number two, inspection of title deeds held by a licensed company to confirm its ownership of the investment property. Number three, board minutes for evidence of management discussion of the change of use and for confirmation of the date and for confirmation of date when owner occupation ceased. Number four, record of the physical inspection of the building, record of physical inspection of building by the auditor to confirm its general condition and that it is no longer and that it is no longer occupied by Lifeson Company. Number five, okay, agreement of the carrying amount of the carrying amount at the date of the change of use to the non-current asset register to the non-current asset register to confirm the correct amount of the fair value gain. Right. So total five evidences, and I hope you get it till here.